Okay, hi everyone. Let's take a look at Billy Bob Hot Dogs, if I can say it correctly. This is a multiple product CVP analysis problem, and I'll read it to you quickly here. Billy Bob lost his job as an SEC attorney because he violated insider trading rules, so now he leases a hot dog stand and sells hot dogs in our nation's capital. The lease on the hot dog stand cost him $1,000 per month. He sells hot dogs and sodas which sell for $3 each. The cost per, oh, and that should say hot dog in there, not hog dog, but the cost per hot dog is 50 cents each, and the cost per soda is 30 cents each. Billy Bob doesn't have any other costs. So question 1 says, if Billy Bob's sales mix is 1.1 hot dogs to sodas, that's the ratio, right? Determine break-even analysis in terms of revenues and number of hot dogs and sodas sold. And that shouldn't be a question mark. It should be a period. All right, let's tackle question 1, then we'll tackle the other ones. Now, I've worked this ahead of time just to save a little bit of time in putting through the demo. So let me turn the color to black here, and we'll work this one. Now, what I've done there is listed the break-even formula, which is fixed cost divided by contribution margin. Okay, well, once we know that, why don't we jot in fixed cost, which is $1,000 per month. And then the next thing I think we want to do is label hot dogs, sodas, and combined. And there's a number of ways to solve it, but this is how I would do it. So we would determine sales per unit, right? Let me bring that to light. $3, $3, and $6. I'll slide up a little bit here. Then we have variable costs, 50 cents, 30 cents for a combined of 80 cents. And we can calculate contribution margin, right? Okay, and all I'm doing here, as you can see, is I'm just subtracting the variable costs across, and then over the combined, we're just summing from the columns. Okay, sum, sum, sum. All right, once we have that, then we can determine break even. So what we need to do is drop in this formula, which is take the fixed cost divided by the combined contribution margin, and we come up with 192.3. Well, what is that? That's combined units. Once we know that, let me slide a little bit here again. Once we know that, we can break that into the various units. Since it's sold as a ratio of 1.1, half of those combined units must be hot dogs and half must be sodas. And we're off just because of rounding. Okay? But now let's prove that truly is the break-even in units. So we can calculate it in dollars. Let me bring all this to light here. And what we see is sales, break-even sales would be $1,154 per month. How did I determine that? I took the combined sales times the sales per unit. In this case, the combined per unit cost is $6, right? $3 for a hot dog, $3 for a soda. Okay, the variable cost, 80 cents times the combined unit, leaves us a contribution margin of 1,000. We subtract off the fixed cost, which we pulled from up there where we originally listed it, and we come up with operating income equal to 0. So we've answered part 1. All right, now question 2 says, assume Billy Bob is operating a level where he's making $2,000 profit per month, and he's thinking about adding pretzels to his product offering. How will that decision impact his fixed and variable costs? Indicate what would change and assume that he will sell 25% pretzels for every hot dog sold. Okay, well, the point of quite a bit of the background information here is that he's operating slightly above break even, right? $2,000 per month. And then they tell us he's adding some variable costs. So without even working the problem, I think it's clear that we will see that variable cost and contribution margin will be impacted, but fixed cost won't change. There's nothing been given that said the cost of the lease of his hot dog stand will go up. Okay? And then 3 says, can you calculate the new break-even in revenues or in hot dogs, sodas, and pretzels sold? And why don't we tackle that? I'll slide on down, and we'll add a few more pieces of information. So this time we have hot dogs, sodas, and pretzels. They sell for $3 each, for combined of $9, but we need to consider a weighting factor, or the product mix of each product. So if you see, what I've done here is I've said we sell one hot dog to a mix of 1 plus 1 plus 0.25. So 44% of the $9 of revenue goes towards hot dogs. Another 44% goes to sodas, and pretzels we need to just divide the 0.25 divided by the total, because we only sell a fourth of a pretzel in relation to the number of hot dogs and sodas we sell. Okay, so with that mix we have a weighting factor we can add in. Then we drop in our variable cost per unit, calculate the contribution margin, and from there we can see what the new break-even is. So let me bring this to light. We say, well, we've got 134 units. How do we do that? We use the break-even formula. We take $1,000 of break-even cost, which was in cell B21. You can't see it on your screen, and divide it by the new contribution margin, which is now $7.45. Okay, then we need to split it based on the ratios. So of 134 combined units, 60 are hot dogs and 60 are sodas. And then 134 times 11% means we're going to sell 15 pretzels. Well, let's see if we did this one correctly. Okay, let me bring all of this to light and we'll see how that turns out. Okay, our proof is 134 units times $9. Variable cost is now $208, $1.55 times 134. Leaves us a contribution margin of $1,000, back off the fixed cost. And sure enough, operating income is 0. So we've proven that that is the correct mix, and we've solved the Billy Bob hot dog CVP analysis problem. Thanks, everyone.